Right, so we are back into our beginner's guide to options. Welcome to Market Measures. Today, we're looking at understanding put options. In the previous section, you learned that call options are theoretically equivalent to 100 shares of long stock for the call owner and 100 shares of short stock for the call seller. Right, so we looked at buying calls and selling calls yesterday. Now, where a lot of people get mixed up is they hear selling and they think put, right? But there are the four options. You can buy and sell calls, or you can buy and sell puts. So today we're going through puts. A put contract is the opposite. Instead of buying a call for speculation to the upside, investors typically buy puts for speculation to the downside, or to hedge their long exposure to shares. Put options, similar to call options, represent 100 shares of stock, but allow the holder to sell at a set price for a limited time, making them valuable when stocks drop. When you own a put option, you can sell shares at the higher price than the market if stock prices fall, acting as a form of insurance for stockholders. So think of it exactly like car insurance, home insurance, contents. So yeah, it's insurance for your stock position to lock in a selling price, though it does require paying your premium. Now, if stock prices rise above the put strike price at expiration, remember we looked at strike price yesterday. So if the underlying stock prices rise above the put strike price at expiration, the put option becomes worthless, as selling at market. The put option becomes worthless as selling at market prices is preferable.
And also a good way of remembering that fixed price is the strike price, which represents it, is the price at which you can buy or sell the asset.
Yes.
Long puts, buying a put option grants a right to sell 100 shares at the strike price, profiting if the stock price falls below this level by expiration. To be profitable, the stock must drop enough to cover the premium paid, as the value of the put increases when the stock price is below the strike price. Short puts. This means selling a put obligates you to buy 100 shares at the strike price if the stock falls below it by expiration. Profit is then made if the stock price stays the same, rises, or does not fall below the strike, allowing you to keep the premium collected up front and using it to offset potential losses if the stock declines.
Exactly. So long puts is a bearish strategy. Short puts is a bullish strategy. Right, let's look at our examples on the Tasty platform then. Buying a put. So that means that you have to pay premium. So it's a debit. The debit is equal to the initial premium, 128 in this case. The max loss is equal to the debit, right? So it's a fixed loss. And in this one, that is the second or the furthest right yellow circle. Max profit is the amount you receive if the stock goes to zero. Okay, so it looks like a huge max profit there, but that calculation is always a little bit meaningless in that, you know, very, very few options go to, stocks go to zero. Now, what about the opposite, selling a put? So that means, of course, you get a credit. You are selling the put to the market, and therefore you are given a premium. Okay, so I am short the put and I receive premium, I receive money for taking that risk, because you're taking the risk and somebody else has the decision to make. The credit is equal to the max profit, and the max loss occurs if the stock goes to zero. Okay, so it's the same as buying shares. You will own that exposure all the way down. So think of it like buying stock, that, you know, anytime you buy stock, then your max loss is if the stock goes to zero. But nobody ever puts that number right in front of you to scare you.
Yeah.
Yes, so that is selling a put and how it looks on the platform. Angeline.
So here are the handy graphs for you to snapshot and print out. So this long put profit graph and short put profit graph. It just is a visualization of how this strategy unfolds. On first glance, it may seem like buying puts is much better than selling puts, as the profit is capped for selling puts, while the losses are much larger. The stock can go to zero, just remember. However, just like with calls, there are many factors, and we'll try and cover as many as possible for you, that may make certain option strategies better under certain conditions. For example, in a bullish market, which can occur the majority of the time, the probability that a stock will go down to zero is very slim, limiting our profits for long puts.
And just so you get used to those, the pictorial representation there, think of the price as going from the left-hand side is lower, and the price moving to the right is the price going up. So I know it's tough because, of course, normally you expect the price to go up would be shown by it going up. But no, on this one, the movement to the right is the stock going higher. And that's why you see the stock price and the strike on that line. Right, this is the one to screenshot as well. So get used to this, because this is the cheat sheet of all cheat sheets when it comes to options. What is your strategy? In what market sentiment should you use that strategy? What is the optimal volatility, which of course will come on to explaining what volatility really is in a lesson next week. In what event is it suitable to trade that strategy? And what are the key factors to monitor, right? So there's so much in that slide. That slide is a whole market measures in itself, which we will come back to, and we'll go over this again and again so we can really, you know, like they do when you're learning a different language, we'll make sure that stays in.
What is it they say? 11 times. You need to say or learn it 11 times before it gets put from your short term to your long term memory.
That's right.
And it's quite tricky, but you know, stick with it, guys, because I know you can do it. Even for myself, I have to think of like different visualizations. So when we're talking about this, I think of a car. Like a put option is like having the right to sell your car at a set price, even though my car is pretty much going close to worthless now. With all the government tinkering with, you know, diesel regulations. So yeah, just find a way that works for you, and we'll be with you along the journey.
And this, I say this slide stuff. There's a lot there. You know, we're not going to do it justice in a kind of 2-minute summary. So next week we'll go through that in a real deep dive look. But very simple example on this. You hear me talking about being short puts on Vodafone, right? Now that is because you can see on the bottom line there, that is a bullish to neutral strategy. Vodafone keep on messing up in Germany, and those numbers aren't great. I'm bullish on the stock because of the buyback, but I'm also neutral at the same time because of the underlying business is struggling in Germany. So therefore, I want to short the puts rather than buying a long call, because a long call is outright bullish. And yeah, that gives, you do that in stable market expectations. So what is the takeaway, Angeline?
So if you ever take just 2 things from this entire segment, being long a put contract allows you to sell 100 shares of stock at the strike price. Long put contracts are profitable at expiration if the stock price is below the strike price chosen by more than the premium paid for the contract. And being short a put contract obligates you to buy or be put Hence the saying, 100 shares of stock, yes, put it to you, at the strike price that's been chosen if the stock is below that strike at expiration. It allows you to bet against the movement of the stock but exposes you to undefined risk to the downside. Short put contracts are 100% profitable if the stop price is above the strike price at expiration.
Wonderful. So that is your Understanding Put Options Beginner's Guide.